I do think crypto is going to lead the way this year because I think it's directly correlated with the agents. And like I wrote last year, I believe Bitcoin has gone through something that needed to happen, and crypto in general, which is when there's an investment situation like AI, where people think they can 10 bag something in a year or 2 years, why would the people that have made billions of dollars in this for the same reason, who don't believe in the ideological side of ETFs and the government being more involved, and the more the government gets more involved and is actually sponsoring it, we want out. I think it makes sense for people to be taking chips off the table. And I think it's held in there extremely well with that going on. And as I put in the next post, once we start to get a breakout, I think crypto will be the best performing asset this year.
The crypto market is moving again, not quietly, not narrowly, but broadly and with conviction. Over the past several sessions, price action across majors and high beta assets has shifted decisively higher, signaling that risk appetite is returning in a meaningful way. Bitcoin is back above 93,000. Ethereum has reclaimed momentum above 3,200, and several large-cap altcoins are posting double-digit weekly gains. What's notable is not just the rally itself, but how it's unfolding: steady, liquid, and supported by macro catalysts rather than speculative frenzy. And this backdrop aligns closely with the framework recently laid out by Jordi Visser, who has consistently argued that crypto's period of underperformance was driven by weak, short-term positioning, not structural decay. With that selling pressure largely absorbed, Jordi believes crypto is now entering a phase where it can outperform in 2026, especially as it converges with artificial intelligence, accelerating money velocity, and shifting capital behavior. Bitcoin, in his view, has already gone through the necessary structural digestion phase, while the broader crypto ecosystem stands to benefit as AI agents begin making decisions, moving capital faster, and reshaping productivity across the economy. Jordi doesn't frame this as speculation. He frames it as a logical outcome of adoption cycles, liquidity dynamics, and demographic change. And that conviction extends beyond crypto, into stocks, commodities, and the broader macro landscape he believes will define the year ahead. In this video, Jordi walks through his full 2026 outlook and delivers a sobering but constructive breakdown of what 2025 actually taught investors, and how to avoid costly mistakes going forward. Later in the video, we bring you important market analysis you don't want to miss, particularly if you have XRP. If you value clear thinking over noise, take a moment to like the video and subscribe, and stay with us as Jordi connects the dots between AI, demographics, and what could be a defining year for crypto and risk assets. Thanks, and enjoy the video.
How does that impact the asset prices? Right? Okay, we got velocity of money, we got all these things, like companies should be making more profit. Let's just go through them. Stocks, Bitcoin, gold. Like, what are you excited about in 2026? And, maybe not like price prediction, but just like, how do you think these different asset classes are going to perform?
So again, I think bonds are going to be completely uninvestable. If you're trying to outperform inflation, I just don't think bonds have enough. You're not getting enough cushion in there. So you're going into the year where credit spreads are at all-time tights, where 10-year yields are not too far away from where 2-year yields are. We do have a steepening yield curve, but so far it's just going at a slow pace. Stocks to me are going to see profit margins, but we're also at the acceleration point for me for a lot of businesses that have not participated yet. The adoption phase is going to be massive. And I want to leave this thought into everyone's minds. And I'm sure at some point we'll get into places, specific areas. But when you make a phone call and you sit on hold, or you get shuffled off to 17 different numbers before you actually get, or you're screaming representative or whatever it is, those areas are the places where you want to start putting money into. If those businesses have revenues growing, they are going to start to be using agents more and more every day, which means their profit margins are going to grow. It's not going to be a huge expense to replace people. And so rather than firing, again, this is more about every year where we normally would have hired 2 million people. Like, just go back. If GDP grows 4% in a year, what's the average amount of human beings that we would hire? Well, the number is now headed to zero, which means 2 million people times $50,000 a year on the aggregate, we're talking huge numbers of productivity gains, not including the ones that we can reduce to go through it. So I do think stocks are just going to have another good year. And it's not just in the US, it's globally. I believe this is going to be a broadening out of AI now. It's not just the adopters. It's also the physical side because we're running into the constraints. In terms of commodities, I think they're going to do well. Not all of them the same, but there's a reason why gold and silver are going higher. Gold got the head start because of central bank purchase, but also because people that doubt the system. And I think we're going to continue to have this AI debate on things. I don't want to talk about the long term at this point, but let's just say I think the commodity side is going to remain durable. I think we will have some worries about natural gas and about copper and silver in terms of running out of supply. Elon Musk brought up silver as, hey, this would be a real problem if we're running out of silver. So I think that's going to be fine. And then when you go outside of it, I do think crypto is going to lead the way this year because I think it's directly correlated with the agents. And like I wrote last year, I believe Bitcoin has gone through something that needed to happen, and crypto in general, which is when there's an investment situation like AI where people think they can 10-bag something in a year or 2 years, why would the people that have made billions of dollars in this for the same reason, who don't believe in the ideological side of ETFs and the government being more involved, and the more the government gets more involved and is actually sponsoring it, we want out. I think it makes sense for people to be taking chips off the table. And I think it's held in there extremely well with that going on. And as I put in the next post, once we start to get a breakout, I think crypto will be the best performing asset this year.
Bitcoin, or you've talked in the past about maybe some other assets that you keep your eye on. How do you look at crypto in general, or is it just like it's all one big trade to you?
Because PMIs to me, if I was going to pick one thing that I feel very, very certain of relative to ADA and where people are, it's the physical upgrade that is coming this year. So we talk about digital workers. Digital workers to me are physical. And I'll give you a little explanation why. And this is in kind of my outlook piece, which is everyone has to start to understand the difference between what they use on their phone with an LLM and if a company starts to have AI agents. AI agents can't be in the cloud. They have to be on site. There has to be the infrastructure necessary. So when we go back to the dot-com bubble conversation, that was building out the bandwidth necessary for what eventually came with mobile. Like we couldn't do what we do on our phones now without having the dot-com bubble. That's why you say, was it worth it? Of course it was worth it because we needed the bandwidth. We just overinvested in the companies that would go through it through the VC world. Now we're at a different point, which is if a big company like Morgan Stanley, where I used to work, wants to have agents and digital workers, they're worried about having it go to the cloud because that's less secure. So they want to have it on site. Well, to have it on site, you're going backwards from the cloud. The cloud was a big investment over the course of the last decade. Well, now if we need to have servers and we need to have routers and we need to have security and everything on site to deal with the agents working 24 hours to where we don't have to worry as much about cyber, all of that stuff becomes on premise. The edge is going to be a theme going forward. And the edge is about physical things. So for me, when the PMIs are going higher, historically, altcoins have outperformed. The ecosystem of crypto has done better. So I expect this year to be a typical year based on the history of crypto, which is Bitcoin will do exceptionally well. The beta names will do better this year. And the reason is because the PMIs will go higher and money supply and all the things that people have kind of thought about will continue to go. But I do want to make one point on the money supply because I hear this a lot. Think about the velocity again. I really do believe that people are underestimating this Caitlin Long theme of once we start getting AI agents making decisions and money flowing in a faster pace, the investors of the world are going to start focusing more on the crypto side. And I just believe you're going to have a lot of new investors focus on the space as a 10-bagger space again. And that doesn't exist right now. And I think once you get people in that, which maybe takes another 6 months, I think that'll be a theme for next year as well.
In his broader 2026 outlook, Jordi takes a measured but confident stance across asset classes. He sees bonds as effectively uninvestable in real terms, given tight credit spreads and insufficient yield to outpace inflation. Equities, on the other hand, benefit from a powerful but underappreciated dynamic: AI-driven productivity gains without mass layoffs. Rather than replacing workers overnight, Jordi argues companies will simply stop hiring, quietly boosting margins as AI agents handle tasks that once required millions of incremental employees. This adoption phase, in his view, is still early, global, and far broader than just big tech. Commodities, meanwhile, remain durable, supported by supply constraints and the physical demands of AI infrastructure, particularly in energy, copper, and silver. But where Jordi's framework becomes especially compelling is how it ties macro momentum directly back to crypto. Rising PMIs, improving money velocity, and on-premise AI infrastructure all point to a more active, faster-moving economic system. Historically, the exact conditions under which crypto outperforms. Bitcoin leads first, he explains, and then higher beta assets follow as liquidity expands. Still, Jordi is careful to ground that optimism in discipline. To understand why conviction matters more than timing, he looks backward, to what 2025 revealed about fear, positioning, and how investors consistently misread transformational technologies.
This wasn't a huge year for stocks. The NDX was only up 20%. The S&P was up about 17%. NDX normally has a higher beta to the S&P. So this wasn't like some kind of bubble type year based on what we heard. The alpha that was generated was a combination of, okay, I don't believe AI is a bubble, but then it was also taking advantages of these fears. The one thing as we end this year, Deutsche Bank had this, there was a post in X and I saw the chart and I showed it on my video 2 weeks ago. And I'm going to do it again this week because I think the point of it was valid. What's the biggest risk for next year? At 57%, it was AI bubble. And number two, I think was like 9%. So it wasn't just that it was the biggest one. It was that in the years of doing this, they've never seen such a wide gap between it. And I think that's because the economy is growing at, the last 2 quarters at close to 4%. Unbelievable. Number two, inflation is headed down. Gas at the pump is going down. The Fed is cutting rates. Profit margins are at all-time highs and earnings are expected to be double digits next year. We have stimulus coming in Q1. So there's not a lot to be bearish about in terms of like the structural part. You got credit spreads at all-time tights. There's no sign of anything going on. So the only thing people can hang on is the AI bubble. And what I think that means for this year is, and honestly, the next few years, AI is a very, very polarizing thing. There are negatives that come associated with it. You have to spend tons of money. Great. Are you going to get the revenues in the door? Number two, is it going to take all of our jobs? Like there's going to be a negative theme because both of those are valid, meaning we don't know when the revenues are coming in to offset the CapEx by the companies. At the same time, we know jobs are going to be impacted by it. Do we have enough power for it? These are questions that will never be answered, in my opinion. This will be a continuous theme for the next few years. And so I think people have to get comfortable with, number one, AI is not a bubble. Number two, when we get the inevitable fears that'll probably happen 2 or 3 times a year, are you in a position to take advantage of the fears? And have you become, you got to stay with the, we're going to eventually be down here type thing. I think that feeds into Bitcoin as well, because I don't worry about years like this when we had back-to-back 100% years in Bitcoin. And then we have a horrible year where it's down 6%. I'm not worried about Bitcoin going forward. What I am worried about is doing something stupid along the pathway to getting there. Here's an interesting thing, again, about what you asked and what triggered in my mind. And I've written about this over the years, but not recently. But I think it's an important thing for people to hear, because I think your comment about an AI bubble, I'm going to basically tell everyone to think of how they view their children as they grow up. In 1993, I guess it was 1994 when Netscape came out. The youngest baby boomer was 30 years old. So you have to think about that. Youngest baby boomer. I'm just outside baby boomer. When the dot-com bubble happened, you're in like the massive earnings years of the youngest baby boomer. Now, the reason that's important is because the baby boomers control the world's money. Their parents were depression babies. So the wealth and the spending is a baby boomer thing. They've been spending. They want to go hardcore. This is not World War II depression or, our grandparents type world. And the reason that's important is because they were young and full of money when the dot-com bubble happened. So it was over enthusiasm. It was, I'm bulletproof. This is the future and I'm going to get involved and I'm going to make lots of money. And that's when the greed and arrogance fit in. There is an age factor to this. Now, the reason I brought up people's children is that's the way your kids are when they're 16, 17, 18, before they go off to college. They're like going to dominate the world. It's hard to talk to them. They've got hormones are flashing. Everything's gone. That's what the dot-com bubble was. It was just over enthusiasm led to overvaluation. Well, now you fast forward 25 years, those baby boomers truly control the world's wealth. Massive wealth distributed in very few hands. And they're at a different stage now. AI and technology have reached this point. There's no bubble because they're not this young group borrowing money to go invest it. There's no borrowing happening except for the CapEx companies, which have the cash to do it. There's no housing bubble. There's no like debt fueled thing that, again, is about the future. So I view this whole thing as being a situation where the people who control the money use AI the least. The people who control the money don't believe in Bitcoin. This is a different situation than 1994. The handoff that's coming is the money's leaving that group and going to the younger group, which may not have it now, but they're getting a little bit of it every day that comes in, and they actually are going to have that enthusiasm. That is the retail traders that you and I get to know. Those are the people in their 30s that are actively involved, and they get called gamblers. And the dot-com bubble was a gambling time. These kids are not gamblers. They are trying to make the wealth that they feel they're entitled to. And again, I've brought up Joseph Schumpeter before, but if you really go through the fourth turning in Joseph Schumpeter and you bring all these things together, it gets into the generational shifting points again. The reason the generational shifting points eventually leads to socialism is because the baby boomers have tons of money. They're giving handouts to their kids. It's a very different thing. So the reason the world is expensive for people is not just that the government keeps printing the money to help keep the distribution of wealth from leading to a revolution. It's the fact that this generational shift, the money's already being handed down by, fine, I know you can't live in New York, but your job's there. I'll subsidize you and I'll give you some money, which keeps the economy going and keeps it going in this point. But it doesn't make people happier. You get socialists in cities, you get the things spreading out in terms of the changes. So I think all of these things get linked back, but this negativity or this, I'm not happy, which is what shows up in all the consumer confidence numbers. This is what allows people to invest and to trade from an opportunistic basis. It's the reason why at the end of the day, I associate Bitcoin completely with the demographic shift that is happening, meaning we need a new system that's more fair. That part I get. The second part is that AI is forcing us faster and faster to get to that point where the demographics and everything speeds up because the older, wealthier people are not using it. And the younger people are going to keep using it more and more. And they're going to start to develop the power and they're going to start making more money. So it's just a question of going through the fourth turning. It's very painful. And I think it's going to continue for the next 4 or 5 years before we, I guess, reach a better point.
Zooming out, the strength we're seeing today is not isolated to one token or one narrative. It's systemic. The initial catalyst may have been geopolitical, with capital rotating into crypto over the weekend following the Venezuela market shock. But what's kept momentum alive is macro. US ISM data came in weaker than expected, reinforcing the disinflationary trend and increasing pressure on the Federal Reserve to respond. At the same time, reports of imminent Fed liquidity injections, including an $8.2 billion operation, have reignited expectations that financial conditions will loosen faster than previously anticipated. For crypto, this combination is critical. Slower growth signals rate cuts, while liquidity injections directly support speculative and high beta assets. This is precisely the environment Jordi Visser has described as fertile ground for crypto leadership. Nowhere is that more evident than in XRP. XRP has emerged as one of the clearest expressions of this renewed risk-on behavior. On January 6th, XRP surged more than 12% to a high of $2.41, decisively clearing the long-standing $2.35 resistance zone, a level that also aligns with the 200-day exponential moving average. This breakout is technically significant. XRP has spent much of the past year capped beneath this level, and reclaiming it shifts the medium-term structure from neutral to bullish. The move triggered the liquidation of approximately $25 million in XRP short positions, contributing to a broader market-wide short squeeze that wiped out over $320 million in bearish bets within a 24-hour window. As a result, XRP's market capitalization has climbed to roughly $144 billion, allowing it to reclaim its position as the fourth largest digital asset, ahead of BNB. Year to date, XRP is now up nearly 30%, making it one of the strongest performers among high-cap cryptocurrencies during this rally. From a technical standpoint, the focus now shifts to whether XRP can hold above the $2.35 to $2.38 zone and secure a daily close above $2.42. If that level is confirmed, the next logical upside targets sit in the $2.60 to $2.70 range. With the psychological $3 level coming into view, should volume and ETF-driven demand continue to tighten supply. Some analysts frame the current structure as a Wyckoff reaccumulation, suggesting that XRP may be transitioning from consolidation into markup. That said, momentum is stretched. The daily RSI is hovering near 87, signaling overbought conditions and raising the probability of a short-term pullback or consolidation. Historically, XRP often retraces 5 to 10% after RSI extremes. But during periods of intense news flow and forced buying, those signals can remain elevated longer than expected. A failure to hold $2.35 would increase the risk of a bearish retest toward the $2.15 to $2 range, but as long as the price remains above former resistance, the trend remains intact. Stepping back, this is exactly the type of environment Jordi Visser has been preparing investors for, one where liquidity, technology, and demographics converge, and crypto begins to assert leadership rather than lag it. The volatility hasn't disappeared, but the structure has improved. And for disciplined investors, that distinction matters. If you found this analysis valuable, like the video, subscribe for more high-signal market breakdowns, and let us know in the comments how you're positioning into this rally. Thanks for watching, and we'll see you in the next one.